our last video, we have discussed financing with debts. In this video, we will move on to convertibles. Most convertibles are issued in the form of a bond or preferred shares. The word convertible means a security can be converted into a given number of common stocks of a company. For example, a convertible bond with conversion ratio of 25:1 means one bond with face value of $1,000 can be converted into 25 common stocks. And the implied converting price is 1,000 divided by 25, which equals $14 per share. Convertible bonds or convertible preferred shares are usually convertible anytime at the option of the investors after a predetermined time span. In our previous example, if company stock suddenly increased to $14.5 per share, which is above the conversion price of $14. In this case, an investor can make a profit through conversion. If stock price fell to $40, an investor can hold on to a bond and receive coupon payment. Convertibles are attractive to investors who do not want to miss out the opportunities of stock price increases, but want to be protected from price falls. As we see, a convertible has both fixed income and equity features, and it is considered a hybrid security. ECM bankers of an investment bank are responsible for underwriting convertibles. An issuer needs to assess the possible impact of convertible issues on its capital structure, because a convertible has both debt and equity features. From the perspective of credit rating, an optional converting convertible is considered to have bond-type characteristics because there is no assurance of converting. As a result, issuance of optional converting convertible weakens a company's balance sheet. On the other hand, a mandatorily converting convertible is sure to be converted into common stock at predetermined time. So from the perspective of credit rating, a mandatorily converting convertible is considered to be more equity-related. Most mandatory convertibles are issued in the form of convertible preferred stock. Aside from credit rating, an issuer also needs to think about possible diluting effects of convertibles. Conversion of convertible bond into common stock increases total number of common stocks outstanding. In case an issuer is worried about falling share prices of the company, additional issuance of convertibles, especially mandatory converting convertibles, may not be a good news to its share price, as the equity feature of convertibles will create downward pressure on its share price. As you would probably like to ask, why would not a company go straight forward to issue bonds, but issue convertible bonds? The answer is that a convertible bond pays lower coupon rate than a loan bond of similar maturity. So companies issue convertible bonds rather than a straightforward bond in order to save financing costs. For example, a company may issue $100 million worth of bond with 7-year maturity at a coupon rate of 6%. And the same company may also be able to issue a convertible bond for the same amount and maturity, but with a coupon rate of 3%. But why convertible bonds are less expensive? As we have discussed, Investors of convertible bonds can both receive coupon payments and benefit from possible increases in share price. The value of convertible bonds thus includes a straight bond and a call option. Convertible bond investors are willing to accept a lower coupon rate than a straight bond coupon because they can make a profit in case of share price increases, and they are also protected against share price decreases. And the future value of a stock might be considerably higher than the bond. Convertible bond investors can generally be split into two broad categories: outright buyers and arbitrage buyers. Outright buyers take long positions in convertible bonds because they want to take advantage of the asymmetric payoff feature of a convertible bond. In other words, outright buyers invest in convertible bonds because they want to speculate that the company's share price will rise above conversion price. But outright buyers are exposed to share price risks. An arbitrage buyer will purchase a convertible security and simultaneously short sell the same issuer's common stock. This hedges away share price risk and creating profits in excess of the coupon through delta hedging. Convertible arbitrage has been used as a call strategy by proprietary trading desks of investment banks and hedge funds. According to Wikipedia, the American convertible bond market was dominated by arbitrage buyers, accounting for 60% of market participants in year 2013. Okay, in this video, we have discussed convertibles. Thanks for watching, and in next week, we will move on to securitized products.